Welcome to It's Your Money, where we provide easy-to-understand tutorials on options trading strategies. Whether you're new to options trading or an experienced trader, you'll find valuable information here. We began this series on option strategies discussing the covered call strategy. In that video, we discussed how you could generate an income from shares you already own. And, in this tutorial, we'll be exploring the protective put strategy, which is one of the most popular options trading strategies used to protect your stock investments. What is the protective put strategy? The protective put strategy is a trading strategy that you can use to protect your stock investments from potential losses. Even if you believe the stock is going up, there's always a risk that it could drop in price. In that case, buying a put option on that stock can help limit your downside risk. Let's say you've heard from a friend about a stock that they believe is a short squeeze candidate called AMC. After researching the stock, you realize the company is struggling and carries a lot of debt. But you also like it as a recovery play and believe the movie theater business will come back quickly after shutdowns. As you further investigate the company, you realize they are, in fact, a candidate for a short squeeze, and the company seems to have a cult-like following that believes in holding on to their shares. You notice that the price has already moved up over 200%, and the hype on social media says it will go higher. You want to buy the stock, but before you do, you consider the possibility and risk of investing in a short squeeze. You eventually settle on a go long by protective puts strategy. How does the protective put strategy work? Let's say you go ahead and purchase 1,000 shares of AMC stock, believing it is a good recovery play, and being a short squeeze candidate is a bonus. You're concerned that you have purchased your shares while the stock is already in a run-up. But you feel comfortable in your decision because you will implement the protective put strategy after buying your shares. You may be asking yourself why you would want to buy a put option on a stock you believed was going to go up. The answer is, you may be wrong. And trying to gauge the direction of the market is something no one can do. To protect your investment, you can buy a put option with an expiration date in the future. This way, if the stock price drops, the put option will increase in value, offsetting the losses in your stock investment. If the stock price stays above the strike price, the put option will expire worthless, but you'll still have your stock investment. If the stock price rises like you anticipated, the put will expire worthless. How to implement the protective put strategy? The protective put strategy has some rules that you will need to follow to make the most of the strategy. These rules include: determine the appropriate strike price. When buying a protective put, it's important to choose a strike price that gives you the level of protection you need, while also considering your risk tolerance. A good rule of thumb is to select a strike price slightly below the current stock price. So in our example of AMC, the purchase price was $42. Therefore, if I wanted to implement the protective put strategy, I would buy a put option somewhere around $40 for some time in the future. Consider the cost of the premium. Protective puts, like your car insurance, come with a premium. And depending on my budget, I can decide whether I would like to purchase 1-month insurance on my stock pick. Or I can consider purchasing a put option 2 months away and just not worry about it. It all will depend on what you would be willing to pay for insurance against a downturn in your stock. Understand the potential loss. Just like your car insurance protects you from loss, your protective puts protect you from a downturn in your stock's price. And while protective puts can protect you from losses, there is a cost associated with them as well. By following these rules, investors can make the most of the protective put strategy and potentially limit their downside risk in the stock market. Conclusion. In conclusion, we buy insurance every day to protect our homes, cars, and health, yet many investors neglect to consider protective puts as a form of insurance for their portfolios against market swings and manipulation. The protective put strategy is an effective way to limit downside risk and safeguard investments from market volatility. However, it's essential to be aware of the associated risks, including the premium cost and the potential loss of the premium if the stock price remains above the strike price. Thank you for watching It's Your Money, and we hope this tutorial has been informative for your trading endeavors. Don't forget to hit the like button and subscribe for future updates. In our next video, we will be covering our third in the series on offensive and defensive strategies you can use to both protect and grow your portfolio. See you there.